Hold on. Have you ever looked at a rundown 3-bedroom house in Sydney? Peeling paint, holes in walls, questionable carpet, maybe a bathroom from 1987, and it sells for $2 million? And you just sit there thinking, how is this possible? Like, who is buying this? And more importantly, how is anyone supposed to catch up? My name is Stan, and I like to spend my time thinking about money, systems, and why things that shouldn't make sense somehow do. If you've ever looked at property prices and felt like the game is a bit broken, you'll probably get something out of this. Subscribe if you want more of these breakdowns. Because this matters. Housing isn't just another expense, it's the expense. It determines where you live, how much you save, and how stressed you feel about money. And most people think the problem is simple. They're just building less. Interest rates are too low. It's just demand. But the reality is, it's a stack of systems, all pushing prices up at the same time. And before we break that down, let's zoom out. Back in the 1960s, home ownership rates in Australia were around 70% plus. Most households owned their home. Fast forward to today, that number is still around the mid-60s. But here's the catch. Ownership among younger people has dropped significantly. More people are renting for longer, buying later, or not buying at all, so it's not that ownership disappeared, it just got pushed further out of reach. First, prices ran ahead of income. This is the core issue. House prices didn't just go up. They outpaced income aggressively. Let's say, in the early 2000s, median house price approximately $300,000. Average income approximately $50,000. That's about 6 times income. Now, median house price in major cities, $900,000 plus. Average income approximately $90,000. That's 10 times income. So even though income almost doubled, house prices tripled. What people think? Houses are expensive, but incomes went up too. What's actually happening? Prices grew faster than your ability to pay. It's like trying to chase a bus. That's accelerating while you're jogging. Second, cheap debt supercharged everything. For years, interest rates were low, really low, which meant people could borrow more. Let's say, at higher interest rates, you might borrow $400,000. At lower rates, you can suddenly borrow $700,000 plus. Same person, same income, just more borrowing power. And when everyone can borrow more, they bid more, which pushes prices up. What people think? Low rates make housing affordable. What's actually happening? Low rates increase prices, not affordability. It's like giving everyone a bigger credit card, and then wondering why everything costs more. Third, supply is slow, but demand isn't. Yes, supply matters. But it's not just we're not building enough. It's how slowly supply responds. Population grows, migration increases. People want to live in specific areas, but building takes years. Approvals, zoning, construction delays. So demand shows up quickly, supply shows up slowly. Let's say 100,000 new households need homes this year, but only 70,000 homes get built. That gap pushes prices up. What people think? Just build more houses. What's actually happening? The system can't respond fast enough. It's like trying to fill a bathtub, while someone keeps turning the tap on faster than you can drain it. Fourth, incentives and investors push prices higher. This is where things get a bit counterintuitive, because some policies designed to help people buy homes actually push prices up. Let's start with first homebuyer incentives, schemes that allow 5%, even 2% deposits backed by the government. On paper, this sounds helpful. Lower deposit leads to easier entry, but think about what happens when thousands of buyers suddenly qualify sooner. More buyers enter the market with less upfront cash, and they all compete for the same homes. So instead of making housing cheaper, it increases demand, which pushes prices higher. Now layer in investors, especially with things like negative gearing. Let's say an investor buys an $800,000 property. Rental income doesn't fully cover costs, so they run a loss. But that loss reduces their taxable income, meaning they get some of it back through tax. At the same time, they're betting on long-term price growth. So even if they lose $10,000 per year, but the property grows $40,000, they're still ahead. What people think? Incentives make housing more affordable. What's actually happening? They increase competition, which increases prices. And investors are just extra buyers. What's actually happening? They're structured to tolerate higher prices than owner-occupiers. It's like giving some players a discount on their losses, while letting others enter the game with barely any deposit. The intention is help, but the outcome, more pressure on prices. Fifth, psychology is doing a lot of the work. This part is underrated because housing isn't just numbers, it's emotion, fear of missing out, security, status. People don't want to be left behind, so they stretch, take bigger loans, bid higher. Let's say a house is worth $900,000. Two buyers get emotional. Suddenly it sells for $980,000. Not because it changed, but because people did. What people think? The market sets the price. What's actually happening? People set the price under pressure. It's like an auction for something you need, not just something you want. Logic starts to bend a bit. Sixth, the system rewards owning, not entering. This is where it feels unfair. Once you're in the market, rising prices help you. Your house goes up, your equity grows. But if you're trying to enter, prices rising makes it harder. Let's say you save $30,000 per year, but house prices rise $60,000 per year. You're technically moving forward, but the goalpost is moving faster. What people think? I just need to save more. What's actually happening? The target is shifting away from you. It's like running on a treadmill, while someone slowly increases the speed. Let's run the math. Let's take a simple example. You want to buy a $900,000 home. Deposit 20%, $180,000. Let's say you save $25,000 per year. That's over 7 years to save the deposit. But if house prices grow at 5% annually, that $900,000 home becomes approximately $1.26 million in 7 years. New 20% deposit, $252,000. So while you were saving $180,000, the target became $252,000. You didn't fall behind, but you didn't catch up either. So what's the actual takeaway? The housing market isn't broken in a random way. It's functioning exactly as the system allows. Prices rose faster than income. Cheap debt increased borrowing power. Supply couldn't keep up. Incentives boosted demand. Investors added pressure, and psychology pushed people to stretch, all at the same time. So when it feels impossible, it's not just you, it's the structure. A few simple rules that could help. Not advice, just patterns that tend to work. Focus on your borrowing reality, not headline prices. What matters is what you can service. Understand timing matters more than perfection, because the system rewards being in, not being perfect. Be aware of emotional decisions. Housing decisions are rarely purely logical. Track your deposit versus price growth. That gap tells you more than anything else. Play your own game, because comparing to others in this market gets messy quickly. And the final thought is this. The market isn't trying to make sense to you. It's just responding to incentives. Once you see that, you stop asking, why is this so crazy? And start asking, how does this actually work? And that's when things start to click.